Good morning, folks. I'm just going to wait a few seconds and allow more people to come through. Okay, that's starting to level off in terms of new people arriving. So I'll get started. So good morning, everyone, and you're very welcome to this morning's InterTrade Ireland Funding Advisory Service Workshop for Established SMEs. I'm really looking forward to hear this morning from, I guess, three of the country's most important public sector bodies, EI, NTMA and SBCI. So as I say, looking forward to it, and I would encourage you to get as much out of the session as possible. And to do that, I would encourage you to use the Q&A function, to ask our contributors any questions that you might have. Additionally, there's an opportunity for attendee businesses to apply to InterTrade Ireland for a one-to-one meeting with a member of the Grant Thornton corporate finance team. We in InterTrade Ireland cover the cost associated with that, and the feedback from those that have availed of that is excellent. So keep an eye out. Those in attendance this morning will get an email from my colleague with a link to apply to that later today or tomorrow. So keep an eye out for that. Before I hand you over to Andrew from Grant Thornton, who's going to give us an economic update, I want to take just 2 minutes to run through some of the ways that InterTrade Ireland supports businesses, right across the island. And I'm going to do this very, very quickly, but at all points, I would encourage you, to get onto our website and take a look at the programs and the supports and the events. So on the Brexit side of things, we're continuing to help businesses, not so much get Brexit ready, but I suppose deal with the impact of Brexit. So lots of supports there that I would encourage you to go on and take a look at. On the growing sales side of things, we help businesses day and daily. That's our bread and butter, I guess, and helping businesses based in the north export into the south and vice versa, that cross-border trade. So I'd encourage you to go on and look at how we support businesses through Elevate, Acumen and these things to grow their cross-border sales. We do a lot of work in the innovation space, helping businesses to become more innovative and to innovate, sometimes for the first time in some time, and other times, as a continuous process. So the likes of our Boost program, I would encourage you to go on and take a look at that. On the funding side of things, that's the team that I work with and for. It's the likes of the Venture Capital Conference, the Seedcorn competition, it's the equity clinics, seed finance business clinics, business planning workshops, and of course this morning's funding advisory service workshop that you're on. Just when I'm referencing that, I would like to draw your attention to our first in-person as opposed to online funding advisory service workshop that will take place on Tuesday, the 21st of June. On the morning of Tuesday the 21st in the Thomas Prior Hall of the Clayton Hotel in Ballsbridge, Dublin. So at that, you'll get the opportunity to hear from and meet with funders that are active right across the country. So I would encourage you to take a look at our website. That event is live on our website for registration. So I would ask you to look at that. And on the tender side of things, my colleague Grant looks after that team, and they help businesses secure contracts, primarily government contracts, that help demystify that and educate and inform companies as to how to go about securing those. So I'll not talk a great deal more about that, but for fear of repeating myself, please do go on and take a look at our website. So back to today's event. I want to do a few thank yous. So I want to thank Michael and Amy from Grant Thornton, who work with us to deliver these. And as you can see on the slide here, I want to give a heartfelt thanks to our contributors, to Andrew from Grant Thornton, to Tom Early from Enterprise Ireland, to John Cantwell from the National Treasury Management Agency, and Sean Farrell from the Strategic Banking Corporation of Ireland. So thanks a million, and I'll hand you straight over to Andrew.
Thank you, Shane. Good morning, everyone. Good to be here. I'm this morning I'm just going to talk a little bit about where the economy is currently, where the Irish economy is, and then just conclude just on some thoughts about maybe some of the headwinds and key issues in the economy as we look in the months ahead. I suppose it's a fast changing environment that we're in, and I suppose it's ever thus, but it feels like particularly fast at the minute. And I was commenting recently that I think in doing economic advisory for nearly 25 years, I think I'm on my fifth once in a career economic shock, and they just keep coming. I think there was hardly room to breathe between the pandemic and then the ending of restrictions, and then we're into the Russian invasion of Ukraine. And so I always like to start by reflecting on where the global economy is, and I think the uncertainty index always captures, I suppose, the global mood. And it was a quite a calm global context during the pandemic, and probably as a result of people not being able to get about and get up to too much mischief. But we're now obviously starting to see a very uncertain context emerge again, and that's really looming large where the economy goes next. It's also making the economy exceptionally difficult to call. And I don't put this slide up to criticize forecasters. I was one for many years and still dabble. Sounds a bit dodgy, but I put this up really just to show how different the economic context is. So the straight line and I suppose the dull line at the top there of pretty straight, standard, consistent growth was the OECD's view of the world when they did their forecasts in November 2019. And then the grayer line there is the OECD's view of the world, obviously looking back and seeing the depth of the pandemic recession, but equally looking forward now into where the economy goes. And I suppose it's very important to draw out that not only is the context different and the path different, and there's a bit more volatility in there, it's also consistently lower than the view of where the economy was heading globally in November 2019. So that would suggest that there's been some reduction in capacity and maybe a bit of permanent scarring. Now, as I say, it's a very difficult economy to call, and we'll see these projections change, no doubt, in the quarters ahead. And later on in my deck here, I do put up central bank projections for Ireland, which tells a similar story around just the difficulty in calling the economy. I suppose one of the key themes that's causing that uncertainty at the minute in forecasters' minds is the fact that inflation is now taking hold. So if I'd given this talk even 4 months ago, we probably would have just still been in that team transitory, I call it, when we were talking about how inflation was as a result of the surge in demand following restrictions being lifted and consumers ready, willing, and able to re-engage in the economy. And then marrying that against supply chain challenges exacerbated by the likes of the Suez Canal blockage and so on, and microchip shortages. It was very much a view that those issues would resolve, and by summer this year we would be through that blip and back on an even keel when it comes to inflation. That hasn't transpired. The Russian invasion of Ukraine has been a massive contributory factor to that, particularly in the likes of commodities and fuel, and that's really driving significant inflation now across the global economy. Well, not quite the global economy. China is still on a fairly even keel when it comes to inflation, as is Japan, but certainly in the US, inflation has taken hold a little bit more, and looks like it'll last a bit longer. And I suppose if we were to summarize where the inflationary path is, we're now talking about higher for longer. As I say, we initially thought that it would have been through this by summer. Higher for longer, we're now talking about peaking in probably January, February, certainly Q1 is the hope of 23, and then taking a while to ease back down to targets. So it's a significantly changed picture than the one that we would have been talking about even 4 months ago. What that means then in terms of the outlook at an EU level, I'll touch on shortly just how I think headwinds are building and talk about the consumer and business sentiment. No forecasters are currently calling a recession. I suppose we should cling to that positive sentiment. I do think headwinds are building and the risks are mounting, but as it stands, the latest forecasts that we have, the likes of the EU's spring forecast, which is very current, just came out in the last week or two, plus our own central bank, no one yet calling a recession. Everyone's calling reduced growth, and we see that at a EU level. The euro area economy projected to grow by 2.7% this year. That was previously being projected to be 4%, but in 2023, they're starting to think that'll be 2.3, whereas previously 2.8. So maybe the gap this year bigger, but certainly then back almost to where they thought it would be in 23. Obviously, as I say, Russia, Ukraine, the influence of that is weighing heavily on the outlooks. How long that goes on for, how that's resolved, what that means then for wheat and various metals and all of that, and gas and fuel, still to be worked through, and certainly nothing seems to be baked in, but the hope is that will resolve sooner rather than later. In trying to unpick the impacts of that and trying to just hone in what that means on the outlook, the OECD have been running the scenarios and modeling through what it might mean for GDP and what it might mean for inflation in the first full year. So in the euro area, the sense is that the total impact of the Russian sanctions and the fuel issues plus commodity price increases will knock about 1.4, maybe 1.5 percentage points off where growth would have been in the absence of these challenges. And on the inflation side, then the sense is that inflationary impact will be another 2 percentage points on inflation. So, a very changed context as a result of those matters. Turning then to where the Irish economy is heading and where the Irish economy is, and I think it's always useful and important just to take a snapshot of where we are today, where the economy has come from, where it's potentially going, and there's lots of fundamental strengths in the economic picture. If we look as to where we've come from, we think that the trade market's strong for Ireland. We're seeing a lot more north-south, south-north trade happening as a result of Brexit and protocol issues, but we're also seeing strength in external markets. We are seeing a very strong labour market, which probably counter to where the thought processes would have been maybe 6 to 9 months ago, where we thought that when the economy reopened, there was that sort of wait and see. Would the consumer be willing to re-engage? Would custom come back? That has happened, fortunately, and the labour market looks very strong. Labour market challenges now in play, actually, in terms of the migrant labour that was so important in sectors like hospitality hasn't returned to the extent that it's now causing capacity challenges in certain sectors, and that again is acting as a bit of a brake on growth. But certainly, as I say, positives in the mix, and the unemployment story is encouraging. Unemployment has fallen back rapidly from the peaks of the pandemic, but I think equally there are glimmers of opportunity, glimmers of optimism to be seen in investment potential. So obviously during the pandemic, investment spend fell dramatically. The projections at the minute are that has bounced back quite well, which maybe is an indicator that businesses have taken a positive view as they came out of the pandemic, and that hopefully then these challenges that we face could be motored through if we can ease through those with maybe some policy support. Just probably worth reflecting very briefly on just where the economy was impacted and what the pandemic did to certain parts of the economy. And we all lived through the closures and the restrictions, so we know, for example, that the biggest impacts were on accommodation and food and hospitality. where there was significant supports required in pandemic unemployment payments, and that retail and hospitality that had to close and stayed closed for longer than other parts of the economy took a particular hit. We're still seeing some of the outworkings of that, and I'll touch on that again just in terms of the sentiment and where the economy is heading. But I suppose it's also worth saying that those supports really did buffer the economy from what could have been a horrendous economic picture. There were lots of supports there, and then the government acted quickly and effectively, I would say, in supporting the economy get through a lot of those challenges. And there's no sector that didn't gain support, but equally, that's not to diminish the exceptionally difficult times that the economy went through. So where do we think the economy is likely to go? I think the central bank probably has it, as well worked through as any that I've seen, and as again the difficulty in calling the economy, not just calling where the economy is going next, but certainly the view on 2021 and how economic performance was then. We're still seeing some of the calculations on that. So we now have a view that the 2021 economy was higher and better than previously thought. Just to explain the two bars there. The left bar is the central bank's forecast from Q1 this year. The grayer bar, the right hand side bar on each of those years is where the central bank's forecasts are in Q2. So just in the space of a quarter, this is the changed view. And again, I stress, I'm not criticizing forecasters, and it's an exceptionally difficult time to try and call the economy, and I don't envy them. 2022 then, previously the sentiment was that 2022 would be a really strong bounce back year of 7%, just over. Again, with the Russia-Ukraine impacts and where the consumer's head is and their willingness to engage, that looks now like it's 4.8%. So while there is still growth potential there, when we think about where inflation's heading, maybe that won't be what we would call real terms growth. That's certainly nominal growth, but we think real terms growth, when we strip out inflation, could tip that into negative territory, but that's all to be seen. 2023 looks a bit brighter. We think, central bank think, and certainly reading the runes in terms of order books and business sentiment and all of that, those leading indicators, we think that 4.3% in 23 is achievable. But as I say, caveat that with the path of inflation and where the sentiment from consumers heads. So just on what I would regard as one of the key leading indicators, and maybe one of the key indicators that predicts potential for recession. And I say that on the basis of work by the likes of Blanchflower, who has looked at consumer sentiment in the US back to the 1980s, and each time it dipped by 5 to 10 points, it was the forebearer of a recession. We're in that sort of territory now, certainly in the US. We're in that sort of drop off in sentiment, the scale of which would suggest there's a recession coming if we're not already in one. In Ireland, we are also seeing a significant drop off in consumer sentiment. That's the green line there has dropped considerably in the last number of months, at levels last seen at the start of the first restrictions in the pandemic. So that's where the consumer's head is at the minute. Quite an emotional, and I suppose I always think, when we think about consumers and business, I think consumers' sentiment is perhaps a little bit more emotional, if you like. We react to what we're seeing in the media, and maybe we're a bit more instinctive about where and reactionary about where the economy is going. But sentiment-wise, when KBC Bank have surveyed people for their sentiment index, what would give me particular concern about where the consumer is heading is that 85% of consumers are expecting to curtail their spending, and that's as a result of that inflationary pressures and that increased uncertainty. So we're seeing lots now written and seeing lots coming through about how people are having to shift from discretionary spend to essential spend, and we're seeing that now we run the Dublin Economic Monitor. I would encourage you to look up the Dublin Economic Monitor in terms of a quarterly bulletin of where the economy is heading across 15 or so indicators, and we're seeing from the MasterCard spending data in that we've seen a shift from discretionary spend, which would be the likes of the meal out, or the big ticket items like a new car or a kitchen and DIY. We're seeing a shift from that, but we're seeing people having to divert that spend into energy, fuel, heat, light and power, etc. And then when we think about potential for interest rates to increase, that adds an extra layer of potential risk into the consumer story. In terms of business optimism and business sentiment, the Bank of Ireland Pulse, the monthly pulse that they produce, is a great source of insight into where the mind of the business community is, and it's starting to show volatility across the cohorts that it tracks. So at a headline level, the reading slightly down, just 1.1 points in the index, which normally you would call that margin of error, nothing to worry about type issue. But when we look then into, okay, well, let's look at retail, for example, down 12.5 points on the previous reading. Probably not unexpected given the consumer sentiment and how consumers feed so directly into where the retailers go. But then construction as well, down 6.8 points on the previous month. So there's something happening in construction, probably linked to supply chain challenges and labor market challenges, is that they just can't start and complete at anything like the pace. And I'm thinking of domestic housing when I say that. They just can't start or complete at anything like the pace that they would want. And there's supply chain input cost issues there, but also labor market skill shortages type challenges coming through there as well. And then on the services sector, actually there's a slight increase on the index there, just at 0.02 uplift. So very mixed across the business community, and that's what you would expect. There's the demands would come in different sectors, and demand would tail off in certain sectors like retail. So mixed picture, but overall a very volatile situation at the minute. And obviously we know that a lot of the issues are linked into where what the impact that Russia-Ukraine is having, and we're seeing that most dramatically in the likes of energy costs, which are having a significant influence on where the economy goes next. So just in terms of where that might go, I think the overriding sense is that those peaks that we've seen in the last month will ebb away. We're seeing lots of effort to increase security of supply. The pace at which that happens is probably not ideal, but we think there's potential to see more OPEC maybe make a move ultimately that will help reduce energy costs, and maybe some policy issues that could address that for consumer. But the path of energy prices there at the moment looks like it'll come back down after those initial peaks. Commodity prices, as we know, have surged. So we're even reading today, and I think I read an article yesterday about how there's not a great store of wheat. So there's not a significant resilience built into wheat supplies, which is again cause for concern, and should see that inflation probably bite in a little bit more, and we'll see that then through into food prices. But a whole range of commodity prices there that have increased significantly since January this year, and that's impacting. We've seen the likes of BMW, Volkswagen talking about having to delay and suspend production lines because there are significant metals that feature in their cars that they just can't get. So again, we're into supply chain challenges and inflationary impacts coming through in input costs, which will, I would say, inevitably, but most likely be passed on to consumers rather than absorbed. So on inflation and where it heads, I think the issue is that it should peak this year. Probably at the minute, we would say peak, early next actually. But when we talk about annual averages, we think that the issues can resolve in 23 and get very much back on track by 23, 24. So that at the minute is probably the hope rather than the expectation, I would say, because at the minute there's still so many uncertainties in the economy. So inflation certainly one to watch. I would say if it hasn't started to if the media hasn't started to report on in better conditions, sort of late autumn, then I think we could be in higher for longer, if that makes sense in terms of where the inflation goes. And just, I suppose, other things that we're watching closely, because there's a lot of bandwidth being taken up by the inflation story. So I suppose these are the key items on our watch list at the minute in terms of where the economy goes. I mentioned interest rates here. They are likely to rise over 2022. My own view would be that would be a mistake, but that's still what looks likely to happen. I say that would likely be a mistake. My view is that inflation's so concentrated in certain areas of the economy that aren't, particularly influenced by interest rate increases. And again, I would have a view that tipping the economy into recession to cool it down, unemployment is significantly more scarring at a personal level and an economic level than inflation. And so, I know it's a balancing act, but I'd say that the interest rate increases that are likely to come down the tracks this year are, loaded with risk about tipping the economy into recession. That said, on some of the other watch lists, the labour market is tightening, has been tightening. I suppose we track the likes of the Indeed online portal for a number of vacancies. That is back at pre-pandemic levels in terms of vacancies, but interestingly, the number of new vacancies being listed in the last 3 to 4 weeks has dropped considerably. So there's maybe a shifting sentiment there in terms of recruitment plans and forward view on the economy, and maybe that's reflective of some of that business sentiment. But the labour market has been tightening. There's a challenge about getting work permits through to get labour into place. And so again, that's something that needs to be considered, because that constrains capacity and ability to deliver for customers. Then some of the macro trends that we're watching, consumer spend and footfall. Obviously, I've talked about consumer sentiment, but footfall I haven't touched on, and footfall is quite dependent, or certainly for cities. The footfall and very linked to the return to offices. So we're wondering, is it a 3-day week average or a 4-day week, or how that's going to pan out? That's unknown at the moment. Encouraging, we're still seeing deals being done on property in the cities. So businesses are certainly minded still to take space, and that's encouraging. But if it's a 3-day week hybrid, that obviously has an impact on passing trade, lunchtime trade, after work, drinks, etc. So again, could just reduce the performance of hospitality and retail. And then on government supports, we're watching closely just to see if we get into the era of windfall taxes, or certainly any direct impact on where, addressing the consumer jitters. We do see moves on energy vouchers and the like. But government supports, there's a massive package of EU rebuilding and repurposing the economy, and very much with an eye on climate resilience and carbon reduction. There's significant pots of money at an EU level, so there's potential injections, and the multiplier effects that they would have could be something that businesses might want to think about how to potentially access. And then trade flows, as I mentioned earlier, trade flows, again, an uncertain era we're in, the Northern Ireland Protocol, which I'll not pretend to understand fully what's going on there, but when I talk to businesses, as I'm doing regularly, there's an acceptance that there are challenges with it, but equally there's an acceptance that it has enhanced the cross-border north-south, south-north trade, and so there are pluses and minuses there. And equally then, from a post-Brexit perspective, seeking out new markets and looking beyond the ease, if you like, that was the GB market. There are opportunities out there as well, and we'll just have to wait and see how in the old economic equation of C plus I plus G plus X minus M, the consumer looks fairly jittery, investment uncertain, but could be strong. Government probably ready to step up and play its part, and it's probably in a better position than it was going into the last big downturn. And then exports and imports, a different context, but certainly an area of opportunity there. So that's a fairly brief overview of where the economy is, where we think it's likely to go, and it's, as I say, very different context than even 3 or 4 months ago. Some glimmers of opportunity, but certainly the headwinds are building. So on that, I will stop and enjoy the rest of the session.
Andrew, thanks very much. That was a great presentation, and I'd just like to ask our panelists now to join us if they can, please. Tom Early, Head of Funding and Scaling Solutions in Enterprise Ireland, Sean Farrell, Head of Product Development, Marketing and Research in the SBCI, and John Cantwell, Senior Private Equity Manager in the NTMA. Good morning, everybody, and thank you very much for joining us. Maybe I might just start with Tom initially, and maybe just in the context of that presentation, you might just share with us some of your observations on the current funding market.
Well, I suppose, and it's really good because I was listening to that and you know, seeing the facts and the figures. What I always think is really interesting to read the media and what's happening out there, because the headlines can also be very doom and gloom and sensationalist, right? I mean, what I mean by that, if you look, I was reading a recent headline and it was proclaiming doom and gloom for the VC industry. Everything was going the way of the dodo. If you look at Q1 2022, so just the recent one, it's significantly behind where we were in Q1 2021, right? But let's put that in context. 2021, I think over $1 billion was invested in companies, and that was just based on the IBCA reports in it, which is double the amount that had happened in 2020. And 2020 was a significant increase on what had happened in 2019. So okay, yeah, we're going back. We're going, but we haven't done as much, or there's not as much activity as was happening in 2021. But 2021 was, I would say, a bumpy year. I'm probably not doing it justice. You know, I suppose where I am seeing a little bit more of a slowdown is really on the absolute big ticket items. You know, we're seeing a lot more of that, those monies, and if you look across Europe, it's a trend when you're talking about the Series D, Series E rounds. You see a lot more of that money coming from outside of the EU. You know, and from an Ireland Inc. or a European viewpoint, I mean, that's not exactly a desirable outcome, because while we have the same sort of level of activity in terms of early stage startups, what it means is that we're building a pipeline of really good companies, and there's the potential that we'll lose control of those operations out of Ireland and I suppose out of Europe. Again, I suppose if I look, and I'm aware there's a big group of people here, if I look in terms of the alternative, in terms of the debt space, I suppose we're seeing an increase in the alternative of non-bank debt providers. But unfortunately, what I've noticed is there's a little bit of reluctance, or maybe it's just a lack of awareness from some of our clients or companies to actually see them as viable alternatives to and banks. Okay, you know, if you look at the consumer reports, Red Sea, you know, they'll say that there's a lot of reduced appetite for credit risk by the banks. And we're seeing now, of course, the exit of Ulster and KBC. As far as I'm concerned, that's a terrible shame, because I'd like to see more innovation coming out of the banking space, if I'm completely honest, and competition is the best way to do that. Party looks at, you know, the unicorn that is Wayflyer and how its alternative debt solution for a company, and it leads me to the question, why would banks have not been able to develop something like this? If I look in terms of the IPO activity and what's going on there, the equity markets have all taken a bit of a dive for certain stocks. But, you know, recently we've had, was it last year, we had two floated on the Euronext, the Irish version of the Euronext, and one of them, Health Beacon, would have been ours. I mean, to be honest with you, you know, our EI is very much committed to the ecosystem in terms of that, and I see IPOs as a viable solution. So it's certainly one of those things that I think we need, as a country, need to focus in on and actually create that funding journey and to help companies scale. So that's a bit of a whirlwind overview of all the different things.
Thanks, Tom. And maybe just bring in John. John, maybe your initial observations and just comments following on from that, Andrew's presentation.
Thanks, Michael. So I'm John Cantwell. So I work for the Ireland Strategic Investment Fund, the ISIF, and many of you will be familiar with us. So we're a state sovereign wealth fund, and we invest in a mixture of fund investments and also direct investments into platforms. So I work on the Indigenous business team, and so we're focused on supporting Indigenous Irish businesses, and we've backed, quite a lot of the private equity funds, private debt funds, venture capital funds that are out in the market. So, on the private debt side, like to Dunport, Beachpoint, Beachbrook, Musenich. On the equity side, the likes of Bernatus, Melior, MML, DevCap, BGF. And then, on the VC side, we've, alongside our Enterprise Ireland, we've supported, most of the VCs that are active in the market. And we also do, some direct equity and debt transactions. So I suppose it's a really interesting time in that, all the focus was on the pandemic over the past 2.5 years. And we had our pandemic stabilization recovery fund for that period, where we supported a number of companies on a direct basis, the likes of Aer Lingus, Genesis, other companies impacted by the pandemic. And, all the focus was on that, going back 2 years ago. Then, we then saw a big surge, I suppose, on the technology side in terms of valuations, in terms of activity, and that's been feeding through in terms of really strong activity in terms of fundraising, and we've had really strong fundraising coming into this period. But now, I suppose what we're seeing is a big kind of wobble in terms of the equity markets. And whilst a lot of what we look at as private markets, so like we've seen, the comparable companies in terms of valuations in for, say, technology companies that maybe, the ones that were on very high revenue multiples, maybe just about break even, or are not profitable. The valuations could be down 50%. So the question is, how's that going to feed through into the private market? And it'll have to feed through. This is only a recent occurrence. The markets it's only over the past number of weeks that the markets have really dropped to this extent. So I think myself that there's going to be an impact in terms of that market going forward. But I suppose in terms of funding overall, the market's still pretty strong, but we are seeing, in terms of companies that are exposed to the higher inflationary costs, that's starting to feed through in terms of company performance. So if you're exposed to cost of food or grain, whatever, as a raw material cost, is going to have a big impact on your margins, based on where things have moved. And similarly in the construction sector. So you were just really seeing that happening over the past number of months. So it's I think we're kind of at an inflection point in terms of the dynamics in the market. But as we stand here, activity has been very strong in terms of actual investment activity, and M&A activities still very strong. But just listening to the presentation earlier, I mean, a lot of this has to feed through into the markets and into different sectors, and it's impacting different sectors in different ways. So it really depends on the extent to which particular sectors are impacted by the inflationary pressures. You're obviously not seeing it so much on the technology side, but then valuations have fallen quite dramatically in terms of listed tech stocks. So it's definitely an interesting time at the moment.
Okay, thank you. Thanks, John. Just bringing Sean in on your views on the current funding market.
Thank you, Michael, and good morning to everybody. So a couple of comments maybe to pick up on some of the points that Andrew made, and also to touch on maybe a couple of the points that Tom made. So for explanation for people who don't know me, I'm the head of product development with the Strategic Banking Corporation, and we're Ireland's national promotional institution. So we're here to intervene in the credit market, so in the debt market, where there's market failures or market gaps. And at a time like the COVID-19 pandemic or other macroeconomic challenges, that's when we really step in. So if you look at the credit markets overall, and Andrew's slide would have spoken to the level of investment that there's been throughout the pandemic, credit demand fell, and the amount of lending that was sought by SMEs fell during that time. But the level of state support lending increased dramatically. So the SBCI, we offer a number of state support schemes, and we also offer liquidity. And since we've been formed, we've collectively delivered over 2.8 billion of a combination of liquidity and guaranteed support lending. 820 million of that was last year in the height of the pandemic, which just showed the level of state guaranteed lending that was delivered. And that was also part of an overall strong suite of direct government support. So again, I was struck by Andrew's slide where there's a number of different levers that will impact what's going to happen over the next while, one being interest rates, and government supports were listed as another lever. And if we look at the Irish SME market versus some of our European counterparts, there's been a very high level of direct supports that Irish SMEs have benefited from, like wage subsidy schemes and pandemic unemployment payment, obviously feeding into that as well. So SMEs have been quite resilient. Overdraft utilization, to give some context, has been lower earlier on this year than it was at the same point last year. So on average, loan balances or current account balances were in a better position. Now, that's whole or pre the impact of the inflationary measures that we're talking about and the supply chain issues that the Ukrainian crisis has brought to bear. So I suppose looking back, I would say that over the last while through the pandemic, SMEs have been very resilient, well supported, fairly low levels of credit appetite on the whole, but with strong levels of government support. Looking into the future and considering whether or not there's, I hate to even use the word recession, but that slowdown that's been spoken about, our view is that it's hard to see interest rates not rising, based on what we're hearing internationally. And also, if you consider that interest rates are rising a little bit, that the level of direct government supports are likely to reduce from what they were at pandemic levels, and that's happening. That may actually lead to an increase in demand for credit, maybe more on the working capital side. So we're looking through our suite of supports with that lens. I'd share the comments that Tom made around looking to see greater competition within the overall banking market. One of our key objectives is to try and support greater competition, and the fact we're going to have fewer banks in the market is absolutely a challenge. Within the SBCI, we are keen and have, through some of our recent schemes, supported those non-bank lenders, including some credit unions that are trying to start lending into that SME market in a more meaningful way. And we see a greater role for non-bank lenders to the SME market in the future. So I guess in summary, the level of state support has been significant at this point. The level of credit appetite will in some ways be determined by inflation and state support as well. And the final point maybe I'd make at this stage is that the last time we had a recession or a real challenge, we had a financial crisis. So we had a crisis within our banks, and the level of capitalization was a real issue. We know that's not the same now. We know our lenders are well capitalized. There is funding available, and whether it be through state support schemes or through banks lending themselves, it's not a lack of funding that's going to be an issue here. Maybe around a lack of appetite at either on lender or at bank or at lender or indeed at SME level. But funding should be available for those who want access.
Okay, Sean, thanks for that. Just regards to the future, do you see additional new schemes coming in from the SBCI, or more funding coming into some of the very successful schemes that have ran?
Sure. So the Future Growth Loan Scheme is probably our most successful long-term investment scheme, which we launched in 2019 for 300 million euro, and subsequently added 500 million euros to that in 2020 in the height of the pandemic. And and that was allocated quite quickly. We are currently reviewing the appropriate successor to that scheme at this point, and we were doing that with a lens to post-pandemic, bridging that investment gap as SMEs look to invest and build for the future in that post-pandemic world. And that's still very much on the runway, and we're looking at that with support and in conjunction with carbon enterprise and carbon bioculture. So plans are ongoing on that front. At the same time, the COVID credit guarantee scheme, which was developed in conjunction with the Department of Enterprise and the guarantee of Taoiseach, that was built under the COVID-19 temporary state aid framework. That is coming to an end at the end of June, and that's outside of the Irish government's control. So in response to that, we're looking to expand what is currently our Brexit impact loan scheme, but also give support to businesses that are impacted by COVID. And while it's early days, we are also looking at the impact of the Ukrainian crisis and what impact inflation might have, and whether or not that's going to lead to an increase in working capital requirements. And again, that's in conjunction with the department. We know from talking to banks and to other lenders that the impact of inflation hasn't really kicked in significantly in terms of working capital requirements, or in terms of current account balances. That may change, and we need to be ready for that if that is the case. So in summary, Mike, yes, we are looking at a follow-on to the very successful Future Growth Loan Scheme, and we're looking to adapt our existing Brexit Impact Loan Scheme to provide for COVID impacted business in the second half of this year. And thirdly, we are assessing what intervention, if any, is necessary to respond to the increase in inflation and the fallout from the supply chain issues and higher commodity prices that we've seen in the recent past.
Thanks, Sean. And I do encourage the audience to come in with questions now. We do have one in, Tom, that maybe you might want to take. Do you think we will see differences in raising funds across the different sectors, but B2B, B2C, medtech, etc.?
Yeah, well, I suppose that there's always differences in those funds right across the sectors. I mean, if you look at it, like your ICT companies are much more likely to get your venture-backed supports, whereas if you look at more like your food companies, they're more likely to avail of the 7-year SBCI type of loans to be able to do that. So yeah, it's going to change. I mean, one of the things like medtech is an interesting one, because that's one where I see an awful lot of growth in at the moment. But if you look at the life sciences and in Ireland, I'm going to be completely honest, it almost looks like there's a valley of death there. I mean, we're very good in terms of funding the ecosystem, providing money into universities to help with the R&D and develop the technical stuff. But when the company is formed and it turns out that there's going to be 10 years before there's a viable commercial sale, there seems to be an element of a gap there in the funding market for that. But similarly enough, then if you flip into, let's take, the ICT types of companies, there's any number of new funds that have come on stream over the last while. I mean, we recently announced 2 of them in terms of Elkstone and Delta. There's a few others that are out there in the marketplace. So there is always going to be differences depending on where they are. I mean, the one thing that I always keep trying to come back to explain to people, because it's always about perspective changes attitude. And what you'll often find is that everybody comes at it with the lens of their economy. And actually, that's the wrong lens to look at things. What they should be doing is looking at it through the lens of, well, hold on, how do I make myself attractive to what the VC's company is or what the bank's company is? Like, what are they looking for? So I would always encourage people to put themselves into somebody else's shoes when they're trying to raise funding. Remember, the investor is doing this despite all the other platitudes that they might come out with around ESG and all the rest. At the end of the day, the investors want to make money. So.
Thanks, Tom. Maybe, John, just bringing you in on, Andrew went to the point of consumer confidence starting to go to a low, but business confidence still seeming to be there. And maybe, do you want to just maybe give any observations that you might have on that and impacts for business over the course of the next while?
Yeah, I mean, I suppose it's an interesting time. I suppose it's still early in terms of the the interest rate cycle. There's a lot of uncertainty around where interest rates are likely to go, and I suppose on the consumer side, the consumer has been hit quite rapidly in terms of the cost of certain products. You go into a supermarket and I think it's clear that prices are going up at the moment. So that's certainly feeding into the sentiment with consumers. It's also there's a lot of talk in the media about interest rates going up. So that's again that's likely to be feeding through to consumers. Whereas on the business side, I suppose a lot depends on what business you're in, and maybe just going back to that question around the different sectors and how they're being impacted. Like, I think that you're going to see very different impacts across, or you're definitely seeing very different impacts between, say, the more traditional sectors and then your tech life sciences sectors. So on the technology life sciences sectors, most of the companies there are probably more focused on raising equity than debt. And the issue there is going to be, obviously, the valuations will come down quite dramatically. It's maybe not as obvious in recent fundraisings by those companies, but the fact that the market, the Nasdaq has fallen so much over the past few weeks, that just has to feed through into valuations going forward. So I think people are going to have to accept lower valuations than they might have got last year in terms of equity fundraisers. So that's going to be a big issue for that for both life sciences and on the technology side. Whereas we get to your more traditional companies on the food side, for example, you're seeing the cost of inflation coming through, and depending obviously what sector you're in, like there's what element of food industry you're in, like inflation's is becoming a big factor, whereas so input costs going up, and also obviously the on labor is also an issue across the economy. So I suppose it's hard to say to answer your questions. It's hard to pinpoint why business sentiment is holding up better than consumer. I'm not 100% sure on that, but certainly the outlook for businesses is quite mixed because of the factors I just described, and particularly interest rates. Who knows where interest rates are going to end up. Whereas on the consumer side, you obviously have you have direct impacts coming through, whereas it depends on what particular sector you're in on the business side, whether you're being impacted or not. So I don't know if that answers the question, but that'd be my kind of thoughts on it.
Yeah, no, thanks, John. Okay, go on ahead, Tom.
But I just make a comment there, because I'm kind of agreeing a lot with what John is saying there. But one of the things that we've seen with the companies that we're working for is in relation to pent-up demand, right? And the reason why I think that they're so optimistic, for want of a better word, is that a lot of them have been sitting around devising plans for the last 2 years. There's been, in a lot of ways, COVID has given a lot of people a chance to rethink where they're going and what they're doing. And it's now about implementation of plans. There's a lot of opportunities that have been recognized that people are trying to see. And we've seen it in our place in terms of the amount of capital expansion projects that are going underway. We're seeing it in terms of the new green energy and efficiencies requirements that are coming down the line, but the companies themselves are actually taking a step to become more sustainable, more lean, more efficient. And of course, the great resignation, as we've been talking about the last while, the labor markets are going, people are going elsewhere. The people are having to stop, reprioritize the work that they're doing, and there seems to be more work than anybody can actually handle at the moment. So I suspect that those factors are coming into play as well.
Okay, we have another question in. Thanks, Tom. We have another question in. Do you predict a downturn in small artisan companies getting started? Does the consumer still have appetite to support us? I'm a small cheese maker. Who wants to take that one?
Right. I'll suppose I'll say something here, and I can probably be completely wrong. Stuff like that. I look. It depends on how the business is operating, what the overheads, how variable they are. But I would always see there would be a place for an artisan type of food company. People will always want to do. I don't know about the rest of you, right? But I am what I describe as a foodie, and when somebody is, putting, your average standard cheese out there versus some premium stuff, I'll always tend to go for the premium. Maybe I won't be buying as much of it now, but when it comes to something like that, artisans, farmers markets, yeah, look, hard to make a call. I'll open it up.
No, we got to keep positive, and like Andrew's kind of referred to, growth expectations for 23 as well. So maybe Sean, I'll bring you in, and I know unfortunately we've only had an hour for this webinar, and I appreciate everybody's, but maybe Sean, you might just kind of maybe comment on the next 12 months and what your views are for the next 12 months.
So I think one of the things I mentioned earlier on, in terms of what's going to drive investment, and we're obviously focused on lending, but investment in general is national policies, and energy efficiency and climate is central to what the government wants to achieve, and that's going to have an impact across both consumer and across SMEs. And we believe that, and this isn't a sales pitch, but in terms of the schemes that we're developing, we believe that we've got to support that. So we're going to announce a scheme specific to energy efficiency in the near future. And I think when we think about SMEs and the variables that we've talked about and the uncertainty, one of the points that we do know is that when you have a shock like what we've seen happen with the Ukrainian invasion, that can sometimes be considered to be a short-term issue. I think there's a realization now that we are in for the medium to long haul of that, and that SMEs, businesses and consumers are going to have to make decisions accordingly. So be that to postpone investment indefinitely or get on with it, because we know that things are going to be dramatically different in 2, 3, 4 months, that we're in for a reasonable haul. So I think that's informing some of what we've seen in the recent past. I think the initial slowdown in investment, because we had seen it starting to pick up in the last quarter of last year, and that's going to change as people make more mature medium-term decisions. So we expect that there will be investment, and that the level of government supports reducing and interest rates are going to be what determines the level of working capital requirement. And that the overall national policy measures around climate and investment in that nature is going to play a big role as well, both for SMEs and for consumers.
Tom, very quickly, closing remarks.
That's a very, very difficult one to answer, but I suppose I'm going to stay positive in relation to this, because it's too easy to get sucked into the negative. Look, we have a wide remit of clients, and look at all different things to different people. We start with startups, we go all the way up to multinationals. I suppose what we're committed to doing is making sure that the ecosystem is vibrant and it can support both startups and companies to grow and scale. So, we've put out the fund of funds for 90 million there. We've announced the 2 new VC funds. There's more of them coming, so that'll help out with the startups. We're doing working with the EIC in relation to European funding and helping our companies, our Irish companies, get that. And even now, my newly established role, which is the funding and scaling solutions team, is to work with both the ecosystem and to help those companies with the potential scheme to access the appropriate sources of finance. So I suppose what I'm saying is there's all these positive things there as well. And yes, we can all focus on the negative. But what I'd say is, and it's often cited, anybody that has a really good company will be able to get funding, right? And actually, I would say, well, that's not 100% true. They have to be ready themselves to get the funding and be able to put their proposition in a very clearly articulate way to a funder. And most companies just expect people to understand their business and not understand the funder's business. So it's very much about that approach. So there's money out there, companies can get it, but they just need to be prepared for it.
John, very, very, thank you, Tom. John, very, very quickly, because we're going over the threshold, maybe just your views and positive or otherwise.
Yeah, I think I'd echo what Tom is saying there. You know, if we go back 10 years ago, you know, the situation is very different now. We've got, you know, we may have less banks, but the banks that we have are pretty well capitalized, and they have a lot of funding available to people, relative to where we were previously. But aside from that, there's, you know, a whole array of sources of capital out there now that wouldn't have been there before. And, you know, in particular, ISIF has supported numerous different platforms across the economy. You know, I don't have time to go through them all here today, but, you know, we've initiatives around supporting Indigenous business that I mentioned earlier. You know, we've backed an awful lot of new climate focused platforms recently, and they will be available to you know, to back projects on that side. We're also active on the regional development side, and in food and agri. So look, I think the whatever happens in terms of the economy, that's you know, it is a big question around that, and you know, I don't have a crystal ball in that regard, but what I can say is that regardless of that, there is, you know, we're, as a country, we're in a much better position in terms of availability of funding than where we were when we entered the last kind of recession, or the last and that's not, I think, was going to be a recession or anything, but it just, you know, we are at a much better place in terms of funding that's available from various different sources. So that's certainly a big positive relative to the past.
Yeah, thanks very much, John, and that's for sure. Unfortunately, we've only got an hour today, but you know, when we do sit down and talk on webinars like this, you see the extent of the government support right throughout the private sector and the private equity, alternative financing, and in areas on the banking that haven't been you know, haven't been as well served. So thank you all for your contributions this morning, John, Tom, Sean, and indeed our economist, Andrew, on behalf of InterTrade. Thank you all very much. As Shane mentioned earlier, we're going to have an in-person event on the 21st of June in the Clayton Hotel. So hopefully that will go very well as well. And then to our marketing team, Amy and Amber, thank you for your help this morning. Thanks very much. Take care. Bye.
Thank you.